Investing in the stock market is an excellent long-term strategy for building wealth. Stocks may be a fantastic long-term investment even when the market is down. Starting off can be a bit of a challenge, though a while ago you could simply dial the phone number of a brokerage firm on Main Street and ask for 100 shares of General Motors. Investment vehicles that are known as funds are now available that allow you to acquire a variety of stock and bond portfolios all at once. A well-diversified portfolio at a cheap cost may be exactly what you want. If so, you're in the right place. Your investment should be spread out so you don't put all your money into one firm or sort of investment. The difficulty is that a newbie might easily become perplexed by the vast array of investment options available. In the event that you're ready to begin investing in stocks or just curious, it is important to know the similarities and the differences between mutual funds, index funds, and ETFs in order to make an informed decision. So, which one is best for you? Many investors are unable to distinguish between these three funds, and the words are commonly used interchangeably, causing confusion among them. The money and time you save in the long run by understanding the differences between index funds, mutual funds, and ETFs is well worth it. Using examples of these three funds, I'll explain this to you, and I'll also tell you which one I recommend for your investment portfolio. Let's start with the things that these three funds have in common. All three types of funds, the ETF, mutual fund, and index fund, have one thing in common. They all allow you to acquire a tiny portion of the underlying assets through a single transaction. An asset is a piece of stock. That is why we cannot differentiate a stock from a mutual fund or an ETF or an index fund, because it is a general term that encompasses all of the three. A good investment needs to be diverse, so what exactly am I trying to say? Assume you have an M&M's candy jar in your hand. Using M&M's as an example of an investment with potential for growth, you'd have a wide variety of M&M's in a great portfolio. One M&M, on the other hand, is an extremely hazardous bet because you're basically putting all your money into one basket. The candy jar itself has access to all of the M&Ms in the candy jar, so you may buy it using an index fund, a mutual fund, or an ETF. However, if you purchase this candy jar, you will only receive a little portion of each M&M that is included within it. You're effectively buying slivers of the company's assets when you invest in that single fund. What advantages does this sort of investment have? The most visible one is that investors can save time by not having to keep track of each stock they want to hold separately. Diversification implies that your risk is spread out across all of your investments, which is a good thing. So that's a commonality of mutual funds, ETFs, and index funds, which is that they allow you to make one transaction, but then you own a little part of whatever it has. There are also some key distinctions between these investment options. Let's take a look at each of these in turn to see how they vary. The first type of investment vehicle I'd like to discuss is a mutual fund. This form of investing approach differs from index funds and ETFs, which are based on indexes. Fund and portfolio managers oversee mutual funds, which are generally comprised of 40 to 100 equities. Index funds and ETFs are very different, but we will get to that in a few. Mutual funds employ a method known as active management. Using the information gathered by these individuals, the fund manager makes investment decisions about which stocks and securities will be added to and removed from the fund. A professional fund manager and an aggressive management style necessitates some sort of financial compensation. That, in essence, is the most significant distinction to be made. The portfolio manager and the research analysts who make all the choices are often compensated by mutual funds charging higher fees. The expense ratio, another term for the annual percentage charged by mutual funds, normally ranges from 1 to 2%. A 1% charge doesn't sound like much, but imagine if you had $100,000 invested in one mutual fund and paid $1,000 a year to have them actively manage it. It is quite a pinch. The only goal of a fund manager is to outperform the benchmark index, whether it is the S&P 500 or another widely used index. Some years they outperform the market, while in others they underperform. Now let's take a look at the index fund. Low expense ratios are a major advantage of the index and exchange-traded funds over traditional mutual funds. So how can index funds and ETFs charge minimal fees for a product that is basically the same? The main difference between an index fund and a mutual fund is that they are managed passively. The term passive management style refers to funds that are not being actively managed by a fund manager. You're undoubtedly thinking now, who decides which stocks to buy and which to sell? An index fund, such as the S&P 500, simply mimics the performance and risk characteristics of the index it tracks. VFIAX, an index fund that tracks the S&P 500, is available for roughly $419. A little portion of the index and the underlying equities are yours to own. Index funds are supposed to outperform actively managed portfolios for the average investor over the long term. This method is supported by Warren Buffett. His index fund strategy beats an actively managed hedge fund by $1 million in 2007, according to a bet he made that year. Yes, he did win. So, in a nutshell, index funds provide low-cost passive management that tracks a variety of markets. The S&P 500 and the Dow Jones Industrial Average are two examples of index funds that you may purchase. In return, the passive management strategy often provides extremely cheap costs. Many times, it tries to replicate the market's risk-adjusted return ratio. Over a lengthy period of time, it's generally better for the ordinary investor. Now let's take a closer look at ETFs now that we've learned about index funds and mutual funds. So, what exactly is an ETF and how does it vary from the previous two? Similarly, an ETF is still a basket of securities, so it's very much like a mutual fund. Even if you buy the ETF outright, you'll only receive a fraction of the total value of the securities in the portfolio. Just like a stock, you can buy and sell an ETF on the market just like you would a stock. It gives you a great deal more power because of its adaptability. An index fund only trades once a day, so you can buy and sell it only once a day. This is something I didn't mention earlier. To buy an ETF on the market, you'll have to pay any brokerage fees for using a brokerage service to purchase the ETF. An additional benefit of ETFs is that thanks to the recent invention of online brokerages offering fractional shares, you can purchase an ETF for less than its current market value. A portion of that share is yours. Contrast this with an index fund, which typically has a lower minimum investment amount. Since I mentioned VFIAX, the minimum investment in that fund is actually $3,000. Because ETFs are traded on the stock market, you have the freedom to buy and sell them as you see fit. To track the market using an ETF, I would stick to an index fund, or if you're going to do it through an ETF, just buy and hold it for a long period of time for better returns. Now, what is the best investment for you? I prefer an index fund over the two other options because I don't want to be bothered with managing or thinking about my investments all the time. One of the advantages of owning an index fund is that dividends are automatically reinvested if you meet the minimum requirements. It's kind of like a product that you can set and forget and come back to in a few years. If you're interested in the underlying asset that the ETF tracks, or if you want the freedom to buy and sell it on the market, or you simply don't have enough money to meet the minimum investment requirement for an index fund, you should consider purchasing an exchange-traded fund. However, I don't think you can go wrong if you choose to invest in an index fund or an ETF. There is a chance that a mutual fund can go very wrong, especially if the fees for that fund are too high or if you choose the wrong mutual fund. Always keep an eye on the expense ratios to ensure that your investment is justified. We all have different opinions on what is what depending on your level of experience, so which investment vehicle do you find more suitable for you? Make sure to leave a comment and share this video with your loved ones so they too can make better investment decisions.